Hello, I'm Corey Raifstenger for the Guardian Life Insurance Company of America. Insurance illustrations do not tell the whole story. Illustrations are great at showing the moving parts, but they're not so good at managing expectations. Though it's easy to get excited to watch your premium work and the cash value accumulate, but what you need to know is three important things. One, the illustration is not the policy. It shows how the policy's value might look in the future on both a guaranteed and a current basis. In other words, a basis that takes into account current interest rates and other key components like mortality experience. Two, the least effective use of an illustration is to assume that it will tell you which of several policies you're looking at would be the best or which insurance company is better than another. And three, because of the infinite number of outcomes with the performance of a variable universal life policy, it is often difficult to discern what is guaranteed and what isn't on a VUL illustration relative to a whole life illustration. In the end, comparing various companies' product illustrations isn't an ideal method of making insurance decisions. My associate Orly Germano, who specializes in working with CPAs, recently spoke with industry consultant Dick Weber. After a 42-year career in various areas of the life insurance industry, today Dick works on behalf of consumers and their advisors to help them better understand, appropriately purchase, and then manage their life insurance policies. Dick and his business partner Chris House have recently written a research paper entitled Life Insurance as an Asset Class. And we've asked Dick to discuss with us some of the highlights from that paper that we felt you would find interesting. In this video segment, Orly and Dick spend about 15 minutes discussing the various life insurance policies designed for lifetime use and how to establish reasonable expectations for how those policies may perform from a financial perspective, which may not be obvious when initially reviewing the policy illustrations. Of course, life insurance is not an investment, but when we use the term performance, we're generally talking about the potential difference between a lifetime policy's guaranteed premium, cash value, and death benefit relative to projections of those features that are not guaranteed. As you'll soon learn, the trick is discerning the difference. Orly?
The use of policy illustrations as a way to start the discussion about how does this policy work began 30 years ago with the introduction of policies that couldn't effectively be sold or purchased without the use of a computer. And Dick has been writing and lecturing about the uses and possible abuses of illustrations for 20 of those years. Dick likes to compare policy illustrations to his favorite quote from the ancient philosopher Aristotle: "A likely impossibility is always preferable to an unconvincing possibility." With that, I'm looking forward to hearing what you have to say about policy illustrations, especially from the perspective of your familiarity with the evolution of illustration technology, regulation, and consumer reaction.
Thanks, Orly. And you're right, I especially like the Aristotle quote because it reminds us that, at least in some respects, human nature hasn't changed very much in the last 2,500 years. I think we've all experienced how compelling the attractive but unlikely outcome can be versus the less attractive but probable outcome. Let's start out acknowledging that buying life insurance or committing to any long-term investment decision can be stressful. It's not something people tend to want to spend a lot of time on, but at the same time, we want to make smart decisions. Because you're making a lifetime commitment to a sophisticated financial instrument, it's important to understand how the policy works. Over the years, life insurance companies have developed the policy illustrations you mentioned, which are typically a computer-generated numerical projection of both guaranteed and possible outcomes, the latter when there are elements of the policy that are not guaranteed, but are possible under certain generally favorable market conditions. By studying these columns of numbers, you can gain an understanding of how the policy is designed to perform over the long term, or at the very least, you can help yourself assess any risk associated with the policy's design's use of non-guaranteed elements and your comfort with that risk. Regulations stipulate that illustrated values must be based on an insurer's actuary-certified current assumptions, but we have to acknowledge that transforming policy design into policy illustrations also can represent optimistic expectations. While assumptions are based on current mortality experience, investment returns, and expenses incurred, they are still just assumptions and can turn out worse or better than anticipated. Further, the underlying price factors can be changed in the future based on actual experience up to the guaranteed schedules described in the policy itself. Another important aspect of policy illustrations for universal and variable universal life insurance policies is that the illustration software is often used to calculate a premium the client should pay because these policies don't have inherent guaranteed premiums. It's the policy owner's responsibility, in fact, to pay enough into the policy so that when combined with interest or investment gains offsetting the internal expense charges of the policy, that the policy will continue to be current or in force, and the death benefit payable no matter when death occurs. But since we have all the underlying uncertainty about future experience of those current assumptions, the premium funding of these types of policies has to be reviewed at least every several years. Where an illustration can be useful is in demonstrating a policy's flexibility. There are a number of ways to use an illustration to highlight a product's best features. So, for example, you might ask, what happens if I want to suspend premium payments? What happens if I want to make withdrawals from the cash value? You might even say, what happens if the illustrated dividend 5 years from now isn't as much as the illustration projected? Well, one way to show a policy's flexibility is to let its potential enhancements fund the out-of-pocket costs for the owner at some time in the future, and this is called premium offset. Another common presentation creates a cash flow scenario. This type of illustration demonstrates how you can leverage withdrawals or policy loans to supplement retirement income, fund a college education, or to provide cash in other situations that might require it. While both may provide an attractive incentive to buy, it's imperative that the client understands that these benefits are projected from assuming substantial non-guaranteed dividends on a whole life policy or non-guaranteed earnings or other factors if it's a universal life product.
That really makes sense. So exactly how can an illustration of projected possibilities be of any value to the consumer? Does it have any realistic value in the decision-making or premium funding process?
The Society of Actuaries, the professional organization that includes many of the insurance industry's technical experts, prepared an extensive report on illustrations back in 1992. That report concluded that a valid purpose of policy illustrations is to show the client how the policy works. An incomplete use is to portray numbers based on certain fixed assumptions in order to compare one policy to another. The actuaries said that most problems arise because of the illusion that the insurance company knows what will happen in the future and that this knowledge has been used to create the illustration. While an illustration is often used to suggest the superiority of one carrier over another or of one policy over another, the Society of Actuaries emphasized that perhaps the least effective use of an illustration is to assume that it will tell you which of several policies you're looking at would be better than another. This is something for which policy illustrations simply were not intended and which can result in unintended consequences. I want to say emphatically, the illustration is not the policy. Rather, it suggests to the buyer how the policy's values might look in the future through economic enhancements that exceed its guaranteed pricing elements. Perhaps the easiest way to explain how a whole life policy works is with a graph. As you can see, cash values increase on a scheduled and guaranteed basis. The difference between the total death benefit and the cash value in any given year is what's called the net amount at risk, and this too is guaranteed in a whole life policy. This graph is simply a visual way of interpreting the insurance company's computer-generated policy illustration numbers representing guaranteed values. At the other end of the spectrum, illustrating variable universal life products presents more of a challenge for the insurance industry than illustrations on whole life policies because none of the traditional elements of premium, cash value, net amount at risk, or death benefits are guaranteed with the variable universal life. this doesn't make this type of policy bad. It can be quite appropriate for policy owners who are accustomed to taking risk for the potential long-term advantages of variable universal life. Unfortunately, when you graph a variable universal life illustration, it looks exactly like the representation of a whole life policy until you realize that one is guaranteed and the other isn't. The variable life insurance policy illustration is making huge assumptions, not only about a projected average rate of return, but also that the average is a suitable assumption, which it's not. You would expect that an illustration for variable universal life would have to show periods of negative growth due to the vacillations of the stock market. And not to get overly technical, the reason the policy represented by this graph collapses near the end is that the net amount at risk didn't diminish as it is guaranteed to do in a whole life policy. Essentially, that net amount at risk is a lot of term insurance with enormous internal charges at age 90 or so, which results in the policy's lapse rather than fulfilling its purpose as a death benefit product for someone who lives only slightly longer than their age group's life expectancy. You know, it's unfortunate. While technology offers some solutions, insurers selling this type of policy have not agreed on the best way to demonstrate the infinite number of possible outcomes of such policies. Illustration regulations have not been as progressive with this type of policy, although I've found it is possible to produce a statistical model that can estimate the probability of success of a given asset allocation and a tentative premium to be paid.
When you and I first met, it was to discuss this very issue, and you explained to me the use of statistical analysis in Monte Carlo. I think those watching this video will find your explanation fascinating, especially because it's in the language that's long been used in the investment world. But we don't hear those words when talking about life insurance.
I'm glad you picked up on that, Orly, because that's what my partner Chris House and I tried to do, was to use the concepts but shift the language to something that more people were familiar with in financial planning and in investment management. Monte Carlo analysis in the context of portfolio return is a way of statistically evaluating a potentially volatile and unknown future outcome based on numerous random samples of prior experience. That's the technobabble. The idea behind this method is simply that no one can reasonably forecast the future based strictly on a linear repetition of the past, nor can it reasonably be projected on the basis of an average return. The analysis can illustrate a probability of success in sustaining a universal or variable universal life policy in force at a specified premium. The graphs show the result of this type of calculation. In the first case, a death benefit of $1 million is funded with an annual premium calculated by the illustration system at $6,035 for a 45-year-old male. This premium is presumed to be paid to age 100. As you can see from this first graph, there's just a 43% success ratio in sustaining this policy in force at this premium rate. I have to ask you, Orly, if you knew that something had only a 43% probability of success, is that something that you'd be enthusiastic about?
Not necessarily.
Okay. This next graph assumes a higher annual premium, $8,240, which produces a 91% success rate. In fact, we used 90% to go back and calculate that $8,240 premium. The random sampling of 55 years of prior investment returns in the policy owner's asset allocation, with 1,000 illustration trials for each scenario, demonstrates the increased complexity of assessing the proper funding and performance of a variable policy. This policy can also be adapted to a universal life product with undulating crediting rates tied to the historic experience of a company's general account assets, which we expect to vary over time. While statistical analysis can establish a better approach for deciding how much premium to pay into either of these types of policies to balance sub-account results or crediting rate expectations, the client's advisor should see that in-force illustrations are conducted every 3 to 5 years to help ensure that the situation hasn't materially changed. Additionally, these policies clearly demonstrate the vast differences between a policy illustration and actual policy performance, and how difficult it can be to discern what is guaranteed and what is not guaranteed, and what might be the reasonable probability of achieving a successful outcome.
You know, Dick, this discussion prompts another issue that I think needs clarification. If we're looking at side-by-side illustration comparisons of two universal life or variable universal life or even whole life policy illustrations, how credible is the implication that one illustration is inevitably better than the other?
That's really the right question at this point. Creating a uniform approach to making realistic pricing assumptions and contractual benefits is part of the challenge, where so many variables in the present must be considered for the future time horizon of a life insurance policy calculation. There are many legitimate reasons why one company's projections, based on current experience, will suggest a different result from another carrier's illustration of a similar product, but what we've needed, at least at the technical level, is a way to assume some industry-wide standards on which to make some decisions, at least about product style. A policy standard is derived from sources such as actuarial tables, levels of investment returns, and average costs incurred by insurance companies in managing their blocks of business. And we've taken that into a hypothetical average policy that's not available for purchase, yet at the same time derives from the experience of the major insurance companies selling policies in today's very competitive market. Here's an example of the whole life standard we developed, comparing pricing and results for whole life policies actually issued in 1974 and held for 30 years. The assessments show 30-year death benefits and total cash values for a 45-year-old male. And we can compare that with the universal life policy standard with the same premium payment in the same period of time. There are a number of essential differences that make it inappropriate to directly attempt to compare a whole life policy to a universal life policy, but it's nonetheless useful information to see without respect to trying to tell the differences about one carrier's policy versus another, how the two types of policies performed during this period of time. It's intriguing to me to then bring a variable universal life policy into the discussion because it's different. It's as dramatically different from whole life as you can get from the standpoint of guarantees, but there's still that inevitable draw to that attractive impossibility. The variable universal life standard shows 4 scenarios with various asset mixes of equity and fixed income returns ranging from conservative to aggressive, and of course the higher the equity mix with historically higher returns for equities than the fixed income return investments underlying whole life and universal life products, a case could potentially be made for a high equity mix variable universal life based on the projected outcome. But consider, there's the substantial risk difference between a whole life policy and a variable life policy, and we've made a projection of a high equity mix allocation from today's age 45 all the way through old age. Well, we know that we'll tend to become more conservative in our investment philosophy as we get older, yet the constancy of projected calculations, including that original allocation, an 80-20, even 100-0, perpetuates the attractive impossibility. So let's look at what happens when we assume an initially high percentage of equity in those sub-account allocations, but then progressively move to a more conservative allocation as we get older. Perhaps not so remarkably, a more realistic approach to risk-taking brings the highly speculative variable style policy right back into the realm of performance of the policy standard's whole life results in the 30-year period begun in 1974. Well, of course, variable universal life benefits are closely tied to the long-term experience of the policy's investment component, and future market conditions can't be accurately anticipated.
With that helpful analysis, it leaves me with one remaining question. How do I choose a policy that will be the best fit for me?
Great question. And I think we've demonstrated that comparing various companies' product illustrations isn't the ideal method because there isn't a good way to make performance comparisons between those styles that are guaranteed versus those styles that aren't guaranteed. So I suggest that advisors and their clients go back to the important issues they've discussed with respect to investing. Assess your risk tolerance style and then consider life insurance policies that are consistent with that style. So if you're young and willing to take the risks associated with equity investing, you may opt to have at least some of your life insurance in a variable type product. If you're older or simply more conservative, a guaranteed premium whole life or so-called no-lapse universal life policy may be appropriate. It simply comes down to a personal choice which a knowledgeable representative can help the client identify. I'd encourage you, Orly, to ask your agent the question in this way. I'm going to pose it slightly differently than the way you did. For my specific budget, time frame of need, risk tolerance, and overall financial situation and resources, what type of policy best meets my needs?
You know, Dick, that's a great way to phrase it. And as I consider my own process of buying life insurance, I really do appreciate your approach to the various styles of permanent life insurance and how they're represented in policy illustrations. Of course, I understand that each individual has their own unique circumstance that should be evaluated. Speaking with your Guardian representative will help you to achieve the life insurance strategy that may work best for you so that you and your beneficiaries will be appropriately protected both now and in the future. For more information on this topic, please ask your Guardian representative for the brochure entitled Policy Illustrations and the Illustration Beauty Contest.